Hello everybody and welcome to today's video, which is about a trading model that is simple for beginners to follow. So the model I'm going to be talking about is the two-step model. I have been doing a series of videos talking about this model, which you can find on the channel. I have been using gold to demonstrate this on a daily basis. So today is Good Friday, and I want to take the opportunity to review what we have been doing. I will provide links to existing videos, either on this video itself or in the description. So right now we are looking at gold. We are on the 20-hour time frame. So I like to explain this using the higher time frames. In my previous video, I talked about how we have a large two-step forming. So we have this point A, this point B, and now this is point C. So the two-step only involves two critical parts. You have your directional move or your trend, and then you have your retracement or your corrective move. That's it. Once you have those two parts, you then decide at point C if you have high enough probability right here to take a trade. So this is a larger two-step. Now there are smaller two steps everywhere. So once you understand this model, you will see these two steps everywhere. There is one thing I do want to talk about because it might get a little confusing. I'm just going to get my notes so we don't lose out. So there is 5 steps to this. Identify range 1, which is your direction, as I just mentioned, or your trend. This is usually the larger, faster range. Okay, swing high, swing low. Then the second part is just your retracement. Again, this can be fast, it can be slow, it can be messy. It doesn't actually matter. The key is that the second range is shorter than the first one. So your retracement range. The key thing to look out for here is looking for price to stall at the 50% or the 70% fib. This is the part that might get confusing. Because if you watch my videos on my channel, I show examples using ES and I use all the fibs, which you can. But for simplicity, you can just focus in on the 50% and the 70%. So let's take a fib. Let's draw it from this high. Or we can draw it from somewhere else. I'm just going to change the fib so it's the correct one. Let's draw it from here. Okay. My eyes are drawn. Let's just extend that. Okay, so my eyes are drawn to where? The 50%. When price is running down, I do nothing. When price is going up, you do nothing because you need the two-step to happen. The first direction, and then the second, the retracement. Only when you have that and price is at the 50% do you start hunting for trades. So you're going to hunt for trades. Now, you may need to take more than one opportunity, so more than one chance to get into the trade, right? There isn't anything as a perfect entry. So you just you just need to be sometimes patient and make sure that you have enough power to take more than one opportunity. Because price can go to the 50%, fake you out, and then go to the 70%. That's possible. So you need to bear that in mind when you're always looking at a two-step. So for example, you may decide you're only going to take trades based on the 72 step because what I always say is your main stop loss is always going to be above point A. That's where your stop loss is going to be. So if price is going up and this is too much of a gap for a stop loss, that means you can't get into the trade. You want price to get higher, as close to point A for you to take your trade. So you could just use the 70%. I use both. I use the 50. I actually use all the fibs, but the main ones are the 50 and the 70. So what are you looking for here? So I mentioned in my videos. The first is you're looking for a reversal. The reversal is just a mini two-step. It's the same thing, but just on a lower time frame. So let's go, say for example, to the 1 hour here. Right here. What do you have right here? This high, this low is formed. Then it's taken out. Okay, what do you have here? That's your range 1. And then what do you have in here? Range 2. This is on 1 hour, but you can repeat this on any time frame. Let's go to the 1 minute. Let me take this off. Okay, let's go here. All right. So what do you have here on the 1 minute? All right. Range 1, range 2. That's it. It doesn't matter. The time frame is irrelevant. The key here is you just understand the model. You need 2 ranges. One long range, as you have here on the 1 minute. Okay, this range here. Let me make it bigger. So this range here is your long range. Take your fib, you can run it from here to here. Right? Where does price go? 50%. And you can keep going, like you could do ticks, for example. The point I'm trying to make here is that I'm going to go back to the 1 hour. And the point I'm trying to make here is that it's just the same thing, just repeating on different time frames. The two-step, one long range and one shorter range. We aim for the 50% or we aim for the 70%. And we just repeat. So at point C, that is the most important point, we are looking for a reversal. Again, the reversal is just a two-step. Then we are looking for SMT. Now, SMT doesn't always occur, but SMT increases your confidence. So at that level, I have SMT. I'm already short here because I have SMT. And then you're looking for a fair value gap to overlap. Those are the 3 main ones. So if I go back to the 20 hour, this level, you have a fair value gap there, overlaps with the 50, has SMT. That's what I need. Now there are other things you can look for. So if I take away this fib, so as an extra, you can use the fixed range volume profile. You can run it from there to there or from other places, right? So you can run it from there to there. I actually run it from there to there. Okay, because that's the better um, swing. Price goes into this low volume node on the 20 hours. Okay, if you run it on a daily, you can run it also on a daily. And you can use different time frames just to make sure you have enough data, low volume node. So there are other things you can check, but there's only 3 that I check. SMT, fair value gap, fibs at point C. That gives you the confidence to then go long or short. So just to repeat, where is your stop loss? So if I go back to the 20 hours, I like to use this. I'll grab the fib again, usually from here, actually, is what I used. Right? So when it comes to fibs, this 50% range to the 70% range is your kill box. Once price gets into this box, that's where you start to hunt. And this is why I said it may take you more than one attempt to get into the trade. So just bear that in mind. When price gets into this box, my initial stop loss is always above the 70. Okay, just above 70. Usually a candle like this one here, just above there. This is just to allow price to initially breathe. But your standard stop loss should be above point A, not here. Okay. Once price moves, once price moves, you can then adjust the stop loss to the last swing point. Now, when price gets closer to the 70, then by default, I always put the stop loss above point A. The only time I play around with that is when price is lower than that 70% fib. Just because price can, like I said, can revisit the 70%. It's not, doesn't mean the model is broken. It just means that price is doing what price will do. So there you have it. Just a review of what we've been doing so far on gold. We have the two-step. If you like the idea of the two-step, or you just want to see more, please like the video and subscribe. Thank you for watching, and I'll see you in the next video.